So something very unusual happened in February of 2026. Google issued 100-year bonds. They are betting that they're going to be a dominant force in the market in the year 2126. But the real question is, why is a company that's sitting on $126 billion of cash, has operating cash flows of almost $200 billion, taking out debt? And in today's video, it's going to be a masterclass on corporate strategy and why debt for a giant like Google is completely different than the debt that you and I take on. So the first thing you have to understand is there's only two ways for a company to raise money: debt and equity. So if we look at a capital stack, it has senior debt, mezzanine debt, preferred equity, and common equity. And as you go up the capital stack, the expected returns for each of those positions goes up. And the cost of capital is the lowest at that senior level debt. So Google is facing an unprecedented amount of spending on AI. Their AI capex for just the year 2026 is expected to be $185 billion. So $185 billion out of what their operating cash flow is expected to be leaves them with free cash flow of around $8 billion. That is a huge chunk of money that's just going to disappear into AI capex. So one of the biggest reasons why they're trying to finance some of that AI capex with long dated debt, corporate debt, is because you're taking some of that spending now and you're stretching it out across the next 100 years. You're pushing that interest rate risk away from your company and onto the people who are buying these bonds. So Google is only attempting to raise about $32 billion worth of bonds, not trying to cover the entire amount of their AI capex for 2026. They're just trying to stretch some of that capex into long dated debt instead of concentrating it into all their free cash flow for the year. So the next question you might have is, why don't they just release more shares and do equity instead of debt? And this takes us back to that capital stack. The expected return on equity is higher than the expected return on that debt. So even though it seems like it's free money to just issue more shares, the company actually has to share a percentage of its earnings with its shareholders. And that percentage is much higher than what they can issue debt at. So Google is actually getting phenomenal rates. Their rates are not that much different than US Treasury bill rates. So US Treasury bills are right around 4%. And if you look at the various bond rates that they're issuing, most of their debt is getting issued at about 5.2%, a very small premium above the risk-free rate of US Treasury bills. Where if they were to issue equity, their expected cost of financing on an equity is about 7%. So they're going to have to return about 7% returns to those shareholders if they issue new shares of Google, as opposed to just paying 5.2% to these bondholders. And when you think about it like that, it introduces this concept called the weighted average cost of capital. So you want your weighted average cost of capital to be as low as possible. Because when you invest in something, it has to be returning more money than your weighted average cost of capital. So if you expect your weighted average cost of capital to be about 6% between your equity and your debt, whatever you're investing in has to make more money than that to justify the investment. So Google is seeing decent returns on their early AI investment across all sectors of their business. So it makes sense to do these large capital investments. This $185 billion investment is justified by the returns they're seeing. But they still want to optimize for that weighted average cost of capital. So let's think about this. For illustration purposes, let's imagine Alphabet's capital structure is 90% equity and 10% debt. So if that 90% equity return is 7.5% and that 10% debt return is 4.3%, then their weighted average cost of capital is about 7.2%. So by modestly increasing the amount of debt in their capital structure by taking on this $32 billion, they're actually bringing down their weighted average cost of capital. And this is just smart business, especially when the appetite for investing in large companies like Google is so high. So originally, Google was only trying to raise about $20 billion, but they were way oversubscribed. The demand for Google's debt was $100 billion. And with all that increased demand, they actually expanded their bond offerings to about $32 billion. But because of that high demand and because of the rates being so close to just free money for them, since they are going to make significant returns well above the cost of capital of this debt, this is why Google is putting their money in bonds, even though they have all this cash flow. And the other reason is just flexibility. Having some cash free is always a good thing. It gives them the opportunity to do mergers, acquisitions, stock buybacks, increase dividends on their stock. That flexibility to choose what you want to do with your cash flow and not dedicating all of it to this short-term AI CapEx spending is just smart business. So what does this mean for you? A bunch of other companies are going to follow this model. They're going to introduce long-dated debt into their capital structures to try and reduce their weighted average cost of capital. And you're already seeing this with Apple, Amazon, Microsoft, Oracle. These companies are starting to issue bonds to lower their weighted average cost of capital on all this AI spending. And just because you hear about these companies issuing bonds doesn't mean that they're actually hurting for money or they're about to go under. It's just smart business. And there are actually tax benefits to issuing debt. So when you issue debt, the interest on that debt is actually tax deductible. So they issue this debt, lowering their weighted average cost of capital, and they actually get tax deductions on the interest on the debt. So just because a company is issuing debt doesn't make them a bad investment. And you really have to look one layer deeper to see what return are they getting on that debt they're issuing. Are they getting Google AI CapEx returns where it's exponentially growing their business? Or are they doing some sort of merger or acquisition that isn't panning out and is consuming their cash flow and tanking their business? You have to go past the numbers, past the headlines, and figure out what their actual return is on the capital that they're issuing. And if today's video gave you some perspective into corporate structures and why issuing debt, even when you're swimming in billions and billions of dollars of cash flow, can make sense, like the video, subscribe to the channel, and share it with someone else who is thinking about investing in one of these tech Goliaths. Keep getting 1% better every day, and I'll catch you in the next video.
Understand the market, keep your vision on the prize, building up the wealth right in front of your eyes. Talk Higgins, yeah, we keep it moving. Talk Higgins, watch the wealth improving. Markets and the money, making sense of the math, helping you navigate the financial path. Talk Higgins, subscribe for the vision. Stay smart, stay invested. We out.